Today I'm going to show you why I think that HIMS stock is a steal deal at these prices and why it has the potential to double up from current levels. I will take you through a discounted cash flow model that I've done, take you through the assumptions first, and then we'll look at the results and see what it says about the company, what it says about the stock price going forward. But if you're new here, I'm Robert. Thanks for watching. We're here looking at stocks from an unbiased perspective, looking at the pros and the cons, trying to find the best potential growth stocks for the future. If you like this type of content, please consider subscribing and liking the video. But yeah, let's look at the valuation that I've done. So I'll take you through my HIMS and HERS discounted cash flow model. So let's start off with the revenue numbers. So what I've taken here is obviously we have a few actuals from the report. So I went into the actual report, the earnings report and the 10K form to get some actual figures for the years 2019 to 2021. And if we start off with revenue, so obviously they are starting off at 82 million from 2019, which represented a 209% growth from the year prior. And then the next following 2 years, they had a growth rate around 80%, leading to 150 and 270 million dollar revenue. And for next year, they have a range which they projected to be in the range of 365 to 380. So I applied a $375 million revenue, representing a 38% growth. And then what you obviously do in a cash flow model, so if you're not familiar with the cash flow model and how it works, is basically you start off with your year, the current year, with the year that it's actually you have actual information on. Then you project 5 years out, you project the revenue, you project the earnings out, and also other inputs such as capital expenditures and amortization, depreciation, and so on. Then those numbers get discounted at a discount rate that you have to choose, which brings it back to today's value, valuing that whole sum of the next 5 years plus an exit number, sort of like a number that someone would get if they buy this company, and that gets summed up as a total number for the enterprise value, and we compare that to the actual stock price and stock value to see if we have a deal there. So yeah, what I've done, but back to this one, but back to the revenue figures. So what I've done for the years coming up, the 4 years of projection. So obviously the first year we've just taken management assumptions because they will know best. And I don't want to play around with that. I'll just take it off straight from the earnings report. And then the next following 4 years, I just assumed a flat 30% revenue growth rate, which might say is a bit undercooked, which also I think that the 38% of management is undercooked for next year, given that all these deals with these big players here, Walgreens, Revolve, Target, Amazon, Walmart, and Uber and stuff like that. So yeah, one could say that the projection of management to have only a 34 to 40% revenue increase is quite low or quite conservative, but let's just go with it. And also let's be conservative going forward. I will just average it out at a 30%, which is still a decent revenue growth. But for a relatively young company like HIMS and HERS, it might be on the lower side and we might see actual higher numbers. But what I wanted to do is be pretty conservative so that whatever result we get, if it's already great, then it can only get better if the numbers do outperform and do surprise to the upside. So that's why we want to be a little bit more conservative to make sure that we're not setting too high expectations. So 30% basically gives us a growth rate that adds up to a $1 billion revenue figure in 2026. So that's the last year of the cash flow projection, which is kind of decent. And I think they have definitely the potential to reach that, given the strong revenue growth, strong demand, and really good numbers that we've seen so far. And yeah, all the partnerships we just mentioned. So a $1 billion revenue figure in 2026 is not that unrealistic, and I do think that they have the potential of might even go to 1.5 or beyond that, So, and then in terms of the margin, so I've taken the actual margin. So obviously we had pretty good margins in the last few years, and then the growth rate of the cost of revenue was kind of off in the last few years. So I just evened it out here to actually align with the gross margin, which I just added up to be slightly higher each year, to be 80% in 2026. So as they're obviously growing their subscriber numbers, their gross margins go up and up. So we've seen a huge jump from around 54 to 74%. But I don't think that we're gonna see, a huge jump going forward. But we will see an improvement of the gross margin going forward, I think, due to the fact that more subscribers will lower the cost of revenue because they the product sets that they're making have a higher margin. Going to net loss, so obviously, as again, this is all actual figures. This is kind of projected for next year. So what they've done is they projected the Ebitda number, the adjusted Ebitda number, which is adjusted for a number of things, but mainly share-based compensation. So if we go here, you can see that how they actually reconcile net loss, which we have here, to the adjusted EBITDA, which we have here. So you can see that there's a few adjustments here, but the key thing is stock-based compensation, which was 67 million in 2021. So I've adjusted for that. Basically went off their next year projection, which is around negative 25 million of adjusted EBITDA, around that range here. So I've put that here, and I've added on another $50 million for stock-based compensation to get to the net loss figure. So this is obviously an assumption from my side, but I do think that we will continue to see these types of stock-based compensation as the company grows and as the company is still in the hyper growth early phase of its operations. So stock-based compensation is expected to still be there, and going forward that compensation will flatten out. So I've in the next year, the 2023, I've given it a 30 million, 25 million, and then just 25 million going forward, which is probably on the higher side, but just to be a little bit conservative here as well. Adjusted EBITDA, I've basically from the year 2023 onwards, I've applied a percentage of revenue to get to that number. So I've applied a 5% number in the year 2023, and then going to 10%, 12%, and eventually 15%, due to the fact that the gross margin is very good. It's around 70 to 80%, and I expect it to be more towards 80% in that year. And then also the fact that obviously right now what's causing the major loss is stock-based compensation plus the marketing and selling expenditure. But as the company is maturing, these costs will expected to be stale or even decline going forward, so that the actual net margin should be higher and should be quite substantial, given the fact that we have higher revenue plus that gross margin percentage is quite high. So we should be able to see, as those operating costs decline, we should see more from that revenue, more from that gross margin to come down to adjusted EBITDA number, to the profit numbers. Yeah, those are my assumptions. Obviously, everyone will have a different figure. So this is just, for entertainment purposes, this is just for you to see what a potential scenario might look like. And what I've done now is I've taken those numbers and I've transferred it over into a discounted cash flow model. So I basically just, whatever I told you right now before, I entered it in here. And those are the 5 years we were talking about. And I have a few other assumptions here that we don't really have to talk about in detail so much. They're just basically off the balance sheet, and I've just rolled them forward. And then obviously also very important, we have key assumptions on that box here. So some of that is taken directly from the income statement and balance sheet. So cash balance, capex, shares outstanding, the current share price. All of that is obviously information that's already out there, and that's not disputable as such. But the first four here, that's quite disputable. So tax rate, I've given them an average of 15%, which might be lower for them. Discount rate, I've went with a 10%, given that I would actually assume that it should be a bit lower than that, given that we are in this environment where it's uncertain how the interest rates are going to develop over time. I've given them a 10% just to be a bit more conservative. We could go lower potentially, and obviously they also don't have any debt as well. So, but the discount rate is just a rate that those cash flows here get discounted in the end. So I just wanted to give it a bit of a higher number to start with. And then the growth rate here, that's the terminal growth rate. So what is the company growing in perpetuity? Which, there's always an average of 2 to 3%, should be in line with kind of GDP numbers of the country. So 2 to 3%, more on the higher side because it's a smaller company with more growth ahead. And then the EV to EBITDA multiple. So this is the multiple of the earnings before interest, depreciation, and amortization. That's on the higher side. I've given them a 20. So I've looked through, some of the competitors here. So Teladoc and a few others, and what their EBITDA multiple is right now. And, I noticed some of them are more higher. Some of them are kind of, negative. They don't make money yet. I do think that, the closest that we can compare to is Teladoc, but obviously because they are much bigger and there's more anticipation around them, they do trade at a higher ratio there. I've given HIMS a 20, which is sort of the midpoint of what I've figured out from those competitors here. So we went with a 20, and what you want to look at is those two boxes here. So the intrinsic value and the market value. So intrinsic value is whatever is calculated based on those cash flows for HIMS. So what we calculated, what should the company be worth so the equity value in total, if you add the cash balance, should be $1.67 billion, which equates to a $9 share price. And obviously the market value, so what is the market valuing the stock at the moment? We are looking at an enterprise value of just around 900 million, which equals the share price of $5.17 at the moment. So we have the discrepancy here between $9, what we calculate, and the $5 that the market is seeing the stock right now, giving us a target price upside of 73% at the moment. And this is us running with kind of a more conservative scenario here, 30% revenue growth from 2023, only be profitable in where do we say? We only said they're going to be profitable basically in 2024, which might even be happen earlier, who knows? And also the level of profitability could be higher. I mean, it could be lower as well, but it does seem that in terms of the risk-reward ratio, going with relatively conservative numbers, we already have a 73% upside. The risk-reward ratio is in favor of the reward, and that's also why HIMS is one of my biggest positions in my portfolio at the moment, because I just think that a 2x from here is easily achievable based on the numbers they're projecting, based on the numbers they've been releasing. Very strong numbers, so 2x very possible. Price to sales ratio at the moment is 3.3, which again, if you compare it to the competitors here, they have all around 4.20, some of them 7. I mean, so some of them are lower, but those are really kind of like no names. I would always compare it with a Teladoc, for instance. So Teladoc, although there's also been hit hard in the last 6 months or in the last 12 months. So Teladoc, although it's also been hit hard in the last 12 months, still trading at a higher price to sales ratio at HIMS, which is probably due to the fact that they are just an older, more established company, more out there than HIMS is quite new to the market. So I guess that's where that discount comes from. But a company like this should probably trade more at a 5, 6, 7 price to sales ratio based on the strong revenue numbers that we have here. For now, we do see a 73% upside here. Let me know what you think. Let me know what your projections are. If you've done a DCF or you've done some other type of valuation model, let me know in the comments below. Let me know what you're seeing here for the next year, or what's the upside for you. I hope you enjoyed, and see you next time.